Hi, welcome to House and Home Chat, Real Estate Real Talk with Dena and Chris. I'm Dena Mathis.
And I'm Chris Breitenbach. Today in our Real Estate Real Talk, we are going to talk about how to create a very strong buyer's offer so that as a buyer, you can get that house. Before we do that, we are going to start with our House and Home Chat. And today we are with Dave Scully. Dave is a Senior Vice President, Area Manager with Ruoff Mortgage. Dave is going to share with us today mortgage strategies for both those of you who plan to buy a new home and for those of you who plan to stay in your current home. Dave and Ruoff Mortgage, by the way, is our small business shout out of the day. So welcome, Dave.
Well, thank you for having me
here today.
Welcome to the program, Dave.
Happy to be
Thanks for
here.
joining us.
Happy to be here.
Well, why don't you just start off by telling us a little bit about yourself and your experience in the mortgage lending business.
Well, I live in Mason with my wife, and we have two kids, one at Wittenberg University, one who lives in Columbus, and our beloved little Portuguese water dog, Mojo.
So cute, Mojo.
A little spoiled.
Mojo, we love that.
He's great. And I've been in the mortgage industry, if I do the math, half my life. So I've been in the mortgage industry for 29 years, seen a lot of ups and downs and changes. So you can do the math on your own.
Right.
But I've never seen a market like we have now, where it's a complete seller's market. I've seen the buyer's market. I've seen normal markets.
Yes.
I've seen market crashes. I've never seen anything like this.
Well, right. With all of our combined experience in the market, it's funny that we haven't ever been in a market like this one.
No.
Correct.
Yeah.
It's just, it's nuts. It's crazy.
It's
and that's why
crazy.
people need to be ready to.
It's crazy. It's fast. So let's just start off with that question that everybody wants to know. And how are the rates? Is it a good time to buy?
Well, it's always a good time to buy. Right?
Well, tell us about those rates.
Well, interest rates have come up a little bit here in the last 2 months. And I don't know what the correlation is between the price of gasoline and interest rates, but for some reason, as interest rates go down, it seems the price of gas goes down, and as interest rates go up,
Interesting.
the price of gas seems to go up. So that's been throughout my career. That's one thing you can always watch.
So you heard it here. Watch those
your
gas
So
prices.
call me crazy. So interest rates, give or take, on a 30-year fixed have gone from 2 3/4, which is still kind of ridiculously low when you think
Still
about
low.
it, to about 3 1/8 or 3 1/4, which is still just historically amazing.
Right.
Which is what helps people to afford the prices as they've gone up a little bit here. So I think that's kind of had a little bit to fuel what's been with what's going on with some of the prices.
So the bottom line is it's a good time to buy.
It's a good time to buy.
Yeah. So where do you see those rates going in the short term here? 6 months, 12 months? Look into your crystal ball.
My
for us,
crystal
Dave.
ball-
What is the
Rates aren't going to change that much.
Okay.
I mean, if you look, you just watch what the economy does. So, if you see unemployment, it's like, I hate to hit you with economics 101, but if you see unemployment go up, interest rates go down. Inflation is the most evil thing there is for all of us, but inflation is the worst thing that could happen to interest rates. So if inflation stays low, which hopefully it will, and unemployment, which should start getting better, but it won't get better than where it was a year ago or 2 years ago for a while, because there's been a lot of people who've been really hurt by COVID.
Yeah.
I would say that interest rates, they may go to 3.5% or 4%, but my God, when I got my first loan in 1994, the interest rates were 8.5%.
Yeah.
Right. I mean,
still.
I hear about those
19.
days. I didn't own a home in those days, but I certainly hear about those.
Well, I can even remember being in high school when interest rates were 23%.
Oh my
I remember
God.
seeing that
I
little
can't-
graph on the
I can't
news.
imagine.
Well, I do remember our first house, which we bought in the early 1990s, had the same or a higher mortgage payment as our second house, which was a significantly higher price.
Wow.
Which again leads to why property values are going higher, because as interest rates go down, it's kind of a yin and a yang. Because you've got more people saying, hey, we can afford more. We can afford more.
Yeah.
Exactly.
So, Dave, what are the, because I don't want to assume people know anything, right? But what are the most popular types of mortgages?
Well, the most popular type is a conventional loan. If you've ever heard of Fannie Mae and Freddie Mac, those are that's the most popular type. That's the one that the sellers want to see the most, because whether it's a real fear or not, of an FHA or VA appraisal where there's a couple of more things that might have to be fixed that an appraiser will require to be fixed, or the FHA or VA guidelines require to have completed before the loan can close.
Right.
Or on a
We've all
conventional loan,
been down that road before, right?
you may not have to put those in. So a conventional loan is always the most popular, but not everybody can get a conventional loan, and it all really boils down to, a lot of it is, buying a house takes 4 criteria: money for a down payment, acceptable credit, income stability, and then an acceptable debt level versus your income. And your credit score is the biggest determining factor of what your interest rate is going to be and what you're going to be able to do. So lending is risk-based now. For years, it never was. So your interest rate had nothing to do, believe it or not, with what your credit score was for years and years and years, until about 15 years ago, and that all changed. So it's almost like car insurance now. So if you're putting down 3% and your credit score is lower, you're going to pay a higher rate for your for your interest rate. You're also going to pay a higher rate for your mortgage insurance as well.
Right.
So your interest rate, I look at it, your interest rate, your credit score is effectively your financial cholesterol level, except higher is better.
I like that.
It's the
Your
truth.
cholesterol level.
That's my
is.
cholesterol.
All right.
Except higher is better.
Yeah.
The higher your credit
The
score,
opposite.
the better your interest rate's
Right.
going to be, the better your mortgage insurance is going to be. It gets even more detailed than that. Even your homeowner's insurance will be less expensive because of your credit score being higher. So the biggest thing everybody needs to do is, raise your credit score.
Get that credit score
and
up.
find out what your FICO score is. Your FICO score is different than what you'll find on Credit Karma. So the Credit Karma score is just a different metric. The highest your score can be from any one of those free services is 900. The highest your score can be on a FICO score is 850.
Okay.
So it's different metrics. It's like if you could drive 100, you could drive 100 miles from here to Columbus, or 125 kilometers from here to Columbus. Bottom line is you're still in Columbus.
Right.
It's just your numbers are a little bit different.
Got it.
So if you think you've got a 720 credit score on Credit Karma, it's probably about 15 to 20 points lower than that for your FICO score.
It's all
I
interesting
did not
stuff.
realize that.
Yeah.
Good.
But believe
Good
me,
thought.
we have
Good
that
learning.
conversation often where people are like,
Yeah.
oh my God, you ran my
Right,
credit score, it
right.
lowered
And
me.
they're
And I'm like,
thinking
no.
it's something else
Right.
than what
you
it
ran,
is.
You ran my credit score.
Yeah,
You
yeah.
you caused the.
You did
Yeah,
something
and-
wrong.
And in reality, all that's happened is they did, your FICO score looks at different things than what the consumer credit will.
Right.
So not
So
to
it's
get too bogged
pooling.
down in it.
It's not, there's not a huge difference, but there are some variances. that
Correct. And
change
I've seen a
the
couple
number.
times where it's higher, but
Yeah.
not often.
Yeah,
So
Got it.
credit score is the key to
very good.
your good financial life.
So we're sending our clients to you to get pre-approved. What do they need? What is that process? What do you need from them to get the pre-approval?
What they need to know is how much money they have in the bank. We need to know where their down payment's going to come from. If you're getting a gift, that's acceptable. A little bit more to document. If you're pulling money from your 401k, let's talk about that now, so you know all the steps to do that, because we may need to close quickly, and if we need to close in 3.5 weeks, you better start working on your on all that information now. That's why you want to get pre-approved before you actually start looking for houses. We also want to make, you'll need your W-2s and pay stubs. And, really look at your pay stubs, because I'll have people that say, oh, I always work, 5 hours overtime every week. Well, you look at their year-to-date income and they don't work 5 hours overtime because the math doesn't actually work. There was a lot of people offer COVID last year, or bonus, income. Know what your bonuses are. And if you're self-employed, prepare to have 2 years of tax returns available, because we'll need to see 2 years of tax returns. Those are the main things.
So is that everything that they need to get pre-approved to start the process then?
Yes, that's kind of the
Okay.
starter kit.
Okay.
So your starter kit are going to be 2 months of bank statements, 1 month of pay stubs, 1 to 2 years of W-2s or tax returns. Those are the main things, because remember, cash, credit, job stability, and debt to income. So if you think of those things, when we run your credit report, we're going to see what your credit score is. That's going to tell us what your debt ratio is as well when we have your income. And when we calculate income, we use the gross income, not the after-tax income. So if you're an employee, so if you're employed through W-2, if you lose 30% to payroll taxes,
Right.
we're not qualifying you on the 70% of your total income. It's the total. You'd be surprised how many people think that.
Yeah.
And things that we don't consider as debts or monthly obligations are cell bills. Those don't count. Homeowner, healthcare insurance doesn't count. Money you take out of your 401k won't hurt you, and any utility bills don't hurt you.
Okay, those are good things to know. Is there a difference between a pre-approval and a pre-qualification?
There is.
Okay.
A pre-approval, and forgive the religious reference here, there's an underwriter who's kind of like St. Peter that gives the thumb up or the thumb down. They sit in ivory towers, God knows where. Yes. I've met some, they're nicer than you think. So they're the ones who did this or down. That's when you've actually turned in all of your W-2s, pay stubs, tax returns, drivers, all this stuff. And when you signed all the documents, you are already approved. You're ready to go. It's like you've got an approved credit card, if you will.
You're approved, not pre-approved.
You are actually approved to buy a house as long as it's within the payment tolerance that you were approved for. So if you were approved based on your debt ratio compared to your income, and you said, hey, I don't want to have my payment to be more than $1,400 a month, as long as that payment isn't going to be more than $1,400 a month, go find a house, just take an appraisal, title work, get your homeowner's insurance. We might need to freshen up a pay stub or bank statement, assume nothing's changed, all is good. So a pre-qualification is where you call and talk to me. So, your loan officer, whoever it might be, is kind of like your priest, your pastor, your rabbi, your whoever, your Yoda, whoever, whatever you want to call them. We're going, let him into heaven, let him into heaven. Let him into heaven. And St. Peter is the one up here.
I love your analogies, Dave.
But in all seriousness, not everybody needs the truth to go through to the next level. If somebody has a credit score of 800 and they're putting down 20%, they've been on their job for 15 years, and there's a lot of people like that, then do we really need to go through all the process ahead of time? It's still not a bad idea to do that, but it's not necessarily required. I know that person's going to be approved.
So that's the pre-qual letter.
That is the pre-qualification, which is versus a pre-approval. So pre-approval means you've already been through underwriting. A pre-qualification means you've spoken to somebody like us and had your credit report pulled.
And we're still calling it a pre-approval then if you've already been through underwriting. Is there like a fully underwritten, this person's ready to go?
Our company has what's called a step ahead program.
Okay.
So which is what I just described, where the underwriter has already approved them.
Yes.
So I would strongly recommend somebody do that if you do have one of the government loans, an FHA, a VA, or I think you do it in USDA too, because it takes that whole, they're only putting down 3.5%.
Right.
I wonder why they're going FHA. Is their credit bad? What's going to make things fall apart? Hey, it's a VA loan. They're a veteran. That's great, but they can put down no money.
Right.
That makes people nervous, unfortunately.
Right. And in this market, as far as a strategy and what we're going to be talking about, a buyer strategy, it's not a bad idea to just get yourself fully underwritten, right? That's just another feather in that buyer's cap.
Right,
well,
because
absolutely.
they're competing with cash. Apparently, the cash is king always, but right now they're winning a lot of deals. That's what we're seeing.
Well,
right?
I do. But my horrified look on my face is, where do these people have $400,000 to just put down?
So for some of you that are listening, you can't see Dave's horrified face.
I don't have $400,000.
You just saw the horrified face when I said cash is king.
But who's got that? Who are these people that have multiple hundrends of thousands of dollars just to pay for houses?
Right.
I'm just scratching my head.
Well, and that's what we're like, how can we help people, right? So that, and part of it's education. Right? If we can say, look, this person doesn't have just a pre-call or pre-approval, they're ready to go. And so therefore, unless this quote doesn't appraise, or unless something major happens,
somebody loses their job, or they do something stupid,
they're
like buy a new car
it's
in
been
between.
fully underwritten per se.
Correct.
So
and
they are strong.
And they should have extra strength then. So you can put that all into a letter.
Absolutely, but even if somebody hasn't been totally pre-approved, we still want to get their W-2s, their pay stubs. There's some tech things that we can use that we can find people's income online, which is kind of slick. But
so it's
we still have that information in front of us. Exactly. You're still better to have always put everything in.
So Dave, you mentioned, we just talked about appraisal, right? And that's going to be part of the process. So one of the creative solutions, because we've been talking in previous episodes of creative solutions to get your offer, one is waiving that appraisal contingency. What are, number one, your thoughts on that? And number two, I always question, because I have seen a lender not approve that or not give the loan. They said you may have waived the appraisal contingency,
but we did not.
But we're not giving you the money.
Well, exactly. So in some instances, when we run a loan through the automated underwriting service, it'll say, hey, the house that this person is buying, they're putting down so much money, it's right for the neighborhood, we'll get what's called a property inspection waiver.
Okay.
So that means we may not need an appraisal. I'm sure you've seen that happen before.
We've seen it happen in the recent.
That happens when you've got the house priced correctly and you've got a good borrower as well. Okay. Now, let's say your borrower says, I want to buy that house, I'll pay $461 or $450 or whatever. It says say $450 and it's only listed for $400. Well, and they didn't get the property inspection waiver when we ran it through. The lender still needs to know what that house is going to appraise for, because the lender, regardless of whoever it is going to consider the sales price or the appraised value, whichever is less is going to be the sales price we're going to use. So, if the house appraises for, if the contract is for $450 and the house appraises for, let's say, $420, and they were putting down 10%, they're going to put 10% down now on the $420 as opposed to the $450. But if they've waived the appraisal, now you're putting down the 10% on the $420 plus you're paying that gap of $30,000.
Right.
So we have to be able to show that you've got that gap to cover that. And a gap of that much, heck, you should have put down 20% anyway at that point because.
Right. Yeah, again, like Chris said, it's a creative strategy. We're seeing it, on a lot of contracts here, and we're seeing some appraisals come back short.
But when they do, that's how that process works. So the buyer can say to tell the seller, we're not going to hold you. We're going to buy your house. If that happens, we're buying your house for the $450.
We're buying.
We're going to have to make up the gap, and that's a dangerous game to play, because what happens if the house was overpriced to begin with? And now
as we're seeing, could potentially be the case here.
And now the house appraises for $380.
Right.
And now there's a $70,000 gap, and now they don't have the money to be able to put down the 10% plus the $70,000.
So ultimately.
So what happens there?
So ultimately, the deal is done then at that price.
Exactly.
Right? Yeah.
And then you're right. You get to the point of, well, why weren't you putting more money down? Or, but with interest rates so low, I do understand that.
I get it, but the appraisal is almost setting the value of the houses, which is kind of backwards, but that's really not the intended goal.
Right.
But in some cases, like we've talked about, the seller will say, hey, we'll come down to the $420. We're still $20,000 higher than what we thought we were going to get. So, because they don't want to go back on the market.
So what if I don't have a lot to put down?
Well, there are no money down programs.
No money down programs.
So a VA loan is a no money down program. A USDA loan is a no money down program. That's property specific. You can do Ohio bond money. That's no money down, but there's income restrictions along with that because of My Communities program. There are no money down programs. But remember, the 4 things to buy, you've said you don't have any money, which means your credit score is going to have to be higher to be able to qualify that. And your debts are going to have to be lower to be able to qualify for that. And if you're doing Ohio Bond, which is a great program, I did a lot of those loans 3 and 4 years ago. And those people have their rates at 4 3/8 or 4.5. And they couldn't refinance because there's a prepayment penalty of 2.5% or up to 5%. So they couldn't refinance without having to pay that back.
Stick with that higher rate. So there are pros and cons. There's no free lunch. Yeah, you're right about that.
Right. And so when we talk about as agents, we tell people to talk to their lender first before they do anything so that they can really understand where they're at and what their options are and what they can do.
Well, because I don't know about you guys, but I always want everybody to know as much as they possibly can. And it's impossible to retain all this. I mean, I've done this for 30 years or however long it is, and I still learn something new every day. And
plus, there are always changes.
And there's always changes.
We'll talk a little bit about those changes
but
too.
It's just I want them to understand, hey, why do we only qualify for an FHA loan? Or why is a conventional loan better for our sake? Or how is the payment going to work? How much are the closing costs going to be, which vary from lender to lender? Why is the interest rate this? I want them to know why it is we're doing this. And every lender asks for a lot of documentation on everything. The understanding of this is actually not that hard. It's the documenting everything that comes in that is really the most tedious part of it. And I always tell people, what are you going to stop asking for if you're giving somebody $100, $200, $300, $400, $500,000 when you're just basing everything on nothing but ink on paper?
Right.
So, think of it that way. Take the broader view. It's painful, but he who has the gold makes the rules, and it's the investors who have the gold and make the rules. We have to follow those rules, and then we have to tell the borrowers to follow the rules that are put in front of us.
Got it. One of the things I was thinking about is, because we were just saying, talk to your lender first. What are things if I'm thinking of buying in the future, and maybe not tomorrow, but what I'm thinking of buying in the future, 6 months out, a year out, or maybe I'm not really thinking of buying, but I want to just keep my options open of what if a house comes up, right? So what are there things that people could be doing to prepare themselves so they set themselves up for the best?
Absolutely. So, a lot of times I talk to people who say, I'm not looking to buy a house for a year.
Mm-hmm.
And as much as you think like, oh, it's not a waste of time, because in a year, they're going to be able to buy, but
Right.
I want to let them know, okay, hey, I don't know what interest rates are going to be in a year.
Mm-hmm.
Right.
So that's the biggest what if. And I
You
don't know
mean
what
you don't
value.
have that crystal ball?
I do.
I thought
know.
you said you did.
If I did,
boy.
believe me,
I hear you.
I wish I did. But then they're setting themselves up, and typically people who I talk to like that are first-time home buyers, right?
Okay.
So they want to understand the process and say, okay, we just signed a lease. We're going to be in this apartment for 1 more year. What can we do?
Mhm.
In some cases, that's, hey, save as much money as you can.
Mhm.
And I explain, why to do that. In some other cases, it's, hey, your credit score is here.
Mhm.
You want to improve your credit score. And I give them some strategies on how to do that. If there's late payments that happen, the farther they get in the rearview mirror,
Mhm.
the better
Yeah.
that's going to be for you.
Right.
If you use more than 30% of the limit of your credit card, it will lower your credit score, even if you've never made a late payment.
Wait, repeat that. If
you overutilize your credit card. So
Uh-huh.
let's
Okay.
say you've got a card that has $1,000 limit,
right.
Okay.
and you have $700 on there. It looks like you're using it at 70% utilization.
Got it.
Okay. If you've got 4 credit cards that have over 30% utilization and you've never made a late payment, your credit score is going to be lower than somebody who's exactly like you are, except they owe less than 30% on all those credit cards.
Okay.
So there's some different nuances that can really help you.
Mhm.
If you have a collection, everybody can have a medical collection. It just happens. You get so many
Mhm.
bills, you don't know what gets paid or
You
who the
oversee
doctor is.
something.
It happens.
Mhm.
So when you have collections, something like that, and be like, hey, you've got a collection for $75, it can tank your credit score, even though you've never had any other issues.
Mhm.
So with that, we don't just say to pay them, assuming you can, but get them removed from your credit report.
Got it.
You don't want to just have them paid and show a zero balance. You want to
Oh.
have that paid and, hey, Mr. Collector, I'll pay you your $75,
Mhm.
but I also want this removed. Quit reporting that this is on here, because then that just goes away and
I
bounce
didn't
it.
know that.
So those are strategies those are
Yeah.
those are the things I want to tell people a year
Right.
out.
Yeah, so that they can get their credit up and they can be ready to pull the trigger
Mhm.
when it's time.
And then they'll be in the best position to be
Mhm.
able to qualify at the time.
Mhm.
And that's just good sound advice anyway,
Yeah.
right? Whether you're buying or not, it's a great financial protection.
Well, it is. It's just, you just have to do some research on it. And it's not fun. I mean, who really, when you get a house, and here's another analogy for you, you're buying a house, it's a financial colonoscopy. I mean, it really is.
God.
But it is.
You heard it here.
But it is. I
Yeah,
mean, it's
yeah.
no fun to get, effectively financially naked over the phone in front of a stranger.
Right,
Yeah.
right.
It's scary. Here's
Yeah.
this person, whether it's me or somebody else, in 15 minutes, you're going to be telling your financial life story. Here's where I work. Here's
Yeah.
my date of birth. Here's my
Right.
email address.
Right.
Here's my
Yeah.
social security
Right.
number.
Full exposure.
Yeah.
Yeah, and that
I
is
get
true.
that. That's true.
And by the way, as a real estate agent, that's a good point. I know I don't ask my clients pretty much anything. I say you talk to your lender. I don't need to know the nuts and bolts and
Right.
details.
Right. Especially
And-
when you've got relationships with these people, it's good to just, you're right, toss it
And-
all over to your lender and have them
And even if
do
I
that,
know my lender,
do that
right?
financial colonoscopy.
Right.
That's not my
And-
job.
I'm not going to know those
You do.
details.
Right,
Exactly.
but there's a thing. A
Good point.
lot of people have had some credit issues. Everybody has stuff happen in their life that nothing is planned, right?
Right.
And when I first got in this industry so many years ago, I was surprised at how many people had bankruptcies. So if somebody has a bankruptcy, it comes off your credit report in 7 years, but you don't have to wait 7 years to buy a house.
Right.
So once it's been cleared and discharged for 2 years, you can look at buying a house and doing an FHA loan.
And these are things that people don't realize.
If you've had a short sale or a foreclosure, it's 3 years from that time the property went out of your house. So you don't have to wait 7 years. So there's people out there who can buy a house now and don't think they can because they've got 7 years stuck in their head.
So come and talk to Dave.
Yeah,
right.
Absolutely.
Can you tell us a little bit about the changes that you see, any implementation of any new things coming up?
Yes. I'm glad that you asked. Just last week, we found out, I don't know exactly when this is going to come. There's 2 big changes coming. One is going to be for everybody. So if you're putting down, if you have these 2 criteria, if you're putting down less than 10% on a conventional loan and your credit score is below 680, the automated underwriting services are basically going to say, we don't want you. So they have actuaries, is that, I can't say the word right,
actuaries.
Just like car insurance and everybody else. They're basically saying, okay, when we have people making late payments, what criteria do they have in common? And there's finding that if there's less than 10% down and lower than a 680 credit score, that there tend to be more late payments and people get in trouble there. So they just would rather not get in trouble there and say, hey, if that's the case, you may have to put down 10% and do an FHA loan if that's what you want to do. So that's one thing. The other thing that you're going to start seeing coming is for rental properties and second homes. Fannie Mae and Freddie Mac don't want any more of their portfolio to be more than, I believe it's 6% of all loans that are done for each institution to be second homes or investment properties. So what you're going to find is that's going to, at some point, that means there's only this much of the pie where there was this much of the pie. So at some point you're going to start seeing those get, those criteria get a little stricter.
Right.
Or you're going to see the rates get higher because as there's fewer dollars in the funnel to do that. So at some point you're going to see interest rates on second homes, which have always been historically the same as if you're buying a first home and buying, putting 10% down, you're going to start seeing those go up, and it'll be institution to institution because, our institution did $5 billion last year in business, which is a lot or a little whatever. Well, 6% of that is $300 million. If it's a smaller company or a larger company, you can see that somebody might have more money than us and somebody have a lot less money than us. So it could change from place to place, the availability of the money to do that.
Got it.
Interesting.
Yeah, so people should buy now.
Buy now. Buy now and get qualified ahead of time and just take out the stress because this is a very nerve-wracking thing. The most nervous thing you should be having to worry about is, can I find the house that I like, that I want to make this investment in? Your nerves shouldn't be, can I get the
That's
loan?
$1 million question.
That is the $1 million question.
Can I find the house? But yes, most definitely.
And we do, obviously, we're like buy now, but not everybody's buying now. So I personally don't foresee that I'm moving in the near future. Are there things I should be considering, or when should somebody think about refinancing, and what are their options there?
Well, people who bought a year ago, if you're paying mortgage insurance and you bought a year ago and you put down 5%, we've had 10 or 15% increase in values. Rates are about the same.
Yeah, that's an excellent point. I hope everybody's listening to that.
You can get rid of your mortgage insurance. Mortgage insurance does nothing for you as a borrower other than allow you to get in the house. That just protects the lender. So that's one thing. Another thing you should look at, if credit cards gotten out of whack and your interest rates are, even if they're 4% or 3.5% or higher, why not do a cash out refinance? And maybe you're at a 30-year loan, or maybe you go down to a 25-year loan and knock a couple years off. And if you're doing that, you can improve your family cash flow and pay off that Visa or Discover card or Apple card or whatever it is, to get your monthly income under a little bit more under control. I don't know, that's suggesting that's the greatest idea in the world. There's some other people who I've seen who are just taking money out and they want to put it in the market. Not personally for me, but if you have a lot of money, tied up in your house, it's really just sitting there, right? You've got a lot of equity. So, do a cash out refinance on your house. And if you want to just put it in the bond market, you're at least going to gain 2% or 3% or something on it.
Good point.
So if you can, if interest rates are 3% and you're gaining 4%, you're still 1% ahead. So that takes a lot of discipline and some luck. But,
those are all really great options, whether you're looking to move and you're, looking to buy a new house, or whether you're staying in your home. Those are some really good options to consider. So Dave, tell us, or tell our listeners how they can reach you.
Well, you reach me a couple of ways. My cell is always the best, 513-633-8476. Or my website, which is just simply davescully.com, DAVESCULLY.com.
I was going to ask you to spell the Scully part.
I've seen some K's and E's in there, but you know.
Very good. Well, thank you for joining us today.
Thank you so much for having me. I hope this was
It's been very insightful to me.
Absolutely. We both learned a lot. We hope that our listeners will learn a lot, and hopefully you'll be able to help a few new people out there.
We are, and the phone call's free, the pre-approval's free, the pre-qualifications are free. Those are services that aren't charged, so don't be scared.
That's a great point.
Great. Thanks, Dave.
Thanks for joining us,
Thank you very much.
So thank you, Dave, for joining us today. And we're going to switch gears just a little bit to our Real Talk portion of our program, where we're talking about how to create that strong buyer's offer. So we really focused in on the mortgage side, the rates, and we want to be able to help you create the strongest buyer's offer out there.
Before we do that, we know every week I pull some sort of a real estate fact insight, and this week what I pulled and I found interesting is for the week time period between April 6th and April 12th, we had 372 listings according to the Cincinnati MLS come on the market. That actually was an increase over last week, still significantly lower than what we like to see.
It's nice to see the numbers going higher, though.
But it is nice to see the numbers increasing
right.
Versus decreasing. Interesting, there were 887 properties that went under contract.
Wow.
So
wow. Look at that variance.
That is, the gap is over 500. So there's these homes going under contract, properties going under contract, 887 of them, but only 372 coming on the market. And so that's creating a huge deficit.
Exactly. So that's exactly what we've been talking about, exactly where we are in the market. Of course, we've got a large number of buyers and a shortage of homes.
Hence, why it is extremely important as a buyer to be writing the best offer to purchase that you can. And so our first strategy for that is contact Dave and have your loan ready to go. I love his comments about taking that next step and having that pre-approval and knowing that really all you have to do is jump through a couple of little minor things in order to get to that closing table.
Yeah, that's exactly right. Having all those boxes checked already and having the strength of putting that into a qualification letter, not just a pre-qual, but an actual approval letter. Exactly. I love that idea. It gives the buyer huge leverage, I think, to compete, to say to this seller that, hey, we've already jumped through those hoops. We've already checked all these boxes, and just barring the things that need to happen that are specific to this home, then we're ready to go financially.
Absolutely. Absolutely.
Yeah. So that's a great point. Have that loan ready. I think another one that's important is to know what's important to the seller.
Yeah.
So this is where it's important for your agent to reach out to the seller's agent, I think, in a lot of cases, and to know what things are important to that seller. It may not always be about price.
Right. I think close date and occupancy date are two huge factors.
They are both really huge factors. Exactly. And you'd be surprised at what small things can tip your contract over the edge and get that contract recognized. Maybe they want occupancy in the house post-closing. Whatever that is, whatever that is important to them, know what that is and talk to your agent. That conversation between agent and client is critical in being able to determine how to put your best foot forward.
Right. And we don't know what that might, what's important to the seller.
It's all going to be
until
specific.
Somebody asks the questions.
Exactly. So communication is key. It's incredible how many times agents may not communicate about those factors, and I think it's hugely important.
And sometimes there just needs to be creative solutions, and creative solutions to one, writing the offer, and number two, maybe finding the correct property.
Yeah, you're working with a really
specific
situation. It's kind of a needle in a haystack right now, trying to find the right home for these buyers, isn't it, Chris?
It is. And so we've done some things like we have driven properties, we've driven the areas, we've driven the streets, and I have reached out to sellers directly, mostly through mail, because I can't access, it's really difficult to access phone records. But
no
we
call lists
have
in a lot of
seen
cases too.
three properties at this point that aren't on the market, or one we found out about the day before it was going on the market, and we were actually able to get into a showing, be one of the first people into a showing. So
yeah,
it's even hard to see properties right now because sellers are getting overwhelmed. So looking at those creative strategies for even getting into a property or becoming aware of homes or that aren't quite on the market yet.
Yeah, exactly. Working with an agent who's willing to look outside the MLS to help you find that home that you're looking for is really important. So yeah, I know that you're working hard on that one. So
we'll get them.
Yeah,
you'll get
them
what they want.
I know you will. I know you will. So another factor I think is important is in making the right concessions. So this is where communication is really important between the agent and buyer, and really evaluating what they're willing to make concessions on. So we've spoken in the past about appraisals. Do they have the ability to, and do they want to? Inspections are another thing. You know, do you have the ability or want to put some parameters around that whole inspection contingency? So, you know, every one of these solutions is not the answer, but really in talking with your buyers and finding out, you know, what are they willing to do?
Right.
How far are they willing to go to win the house? What concessions are they willing to make?
What are they willing to give up? Yeah. Basically, what are you willing to give up in order to get the house?
Exactly. And you know, you have to put all the information out there for them, I think, allow them to make the choice that's right for them, but you should be presenting these options to your buyers.
Correct. Yes. Yeah. Exactly. And our personal feelings, I personally would have a very hard time buying a house or recommending somebody buy a house without an inspection. But I tell you what, I'm going to talk to my clients about that right now. About, hey, here are some options with an inspection, and it's your decision. That's not my decision. It is your decision. And how bad do you want the house?
Exactly. How bad do you want the house? What are you willing to do for it? You know, there are plenty of, you know, people I've worked with, buyers I've worked with in the past, for example, that are maybe more handy, that are contractors that are like, I don't care, Dena, you know, I don't really care. Right. Whatever I find in this house, you know, I'm going to take care of it. I'm going to fix it. Again, as long as you're providing all that information, there's full disclosure, everybody knows what the risks are. Right. These are options to consider at this time when you're trying to, again, win the contract, right? With so much competition. Yeah.
You know, another strategy that comes up in conversation quite a bit is the escalation clause. And a lot of people don't understand what an escalation clause is, but when you write an offer to purchase a house, you are going to give the price that you are willing to pay. And what in our market right now, we are seeing that there might be 5 offers, 10 offers, 20 offers, all on that same house. So what an escalation clause is going to do is say, hey, I'm going to offer X, but if Bobby and Sue over there offer Y, I want to outbeat them. So I'm going to offer X, but if you get another offer that's higher, I'll pay more.
Exactly.
And maybe it's $1,000, maybe it's $2,000, but I'll pay more up to another price.
Up into a cap. Right. Exactly. So I will offer, for example, $10,000 over your highest price that somebody is offered. So you're going to put yourself $10,000 maybe, just, you know, as an example, over the best offer, but you put a cap on that saying up to $300,000
Exactly.
or whatever it is that is your ceiling. And they're interesting. Again, I look at them as a tool. They've got pros and cons, but it's another tool that we can use in today's market to create the strongest buyer offer. What are your thoughts?
Right. I have used escalation clauses. I think there is a time to use them. I think and I think from a seller's perspective, because I work with a lot of listings. From a seller's perspective, I will tell you, if somebody gives me an escalation clause with a cap, they should counter back at that cap, because you as a buyer have just told that seller how much you're willing to pay for that home. And so again, what we would do is, if I'm representing you as a buyer, I'm going to explain that to you, that you're showing your highest and best. They can come back and counter. It's not like they have to take the escalation,
right.
But I just will make you aware of it. I have seen some sellers in the multiple offer situation kick out all escalation clauses and say, because the seller sometimes they don't understand, and maybe their agent's not explaining it fully to them. And so therefore they're going to choose to say no rather than say yes. And so again, I'm not against using them. I do think there's a time and a place to use them, but you as my buyer need to be aware what could happen.
Yeah, exactly. It can be a double-edged sword. Like you said, you've just let that seller know how much you're willing to pay for their home. So from that, strategy that we used to put in place, where you played this game of, offering and counter offering and then coming back, but never really disclosing what your ceiling is. You always kept that close to the vest. This kind of shoots, a hole in that and puts it all out there and says exactly what you're willing to, the highest bid that you're willing to pay for this house. But again, this market being so fast and so different, if your goal is to win the house and you are willing to pay that price, then maybe the escalation clause is the way to go. So situational. Yeah, absolutely. And another factor, I think, is the strength of the realtor's relationship, Chris, with other agents. So, we get together regularly. There are meetings, there are shared listings that are coming up and coming soon. We all have our place within the community where people know where we sell, where we have buyers, and we've got 30 some years of experience between the two of us. We've pretty much worked with just about every agent, in the city. So we've had some relationships with everyone. And it's amazing to me how many times people will come to me and say, do you have anything, coming up in a certain area? I've got buyers that are looking. And I do the same. If I know that an agent lives in a specific neighborhood and they sell a lot there and I'm looking for a buyer, that's where I'm going first. Do you have anything coming up? Right.
And, there's also that feeling of experience of working with other agents, and we will work with anybody. To me, it doesn't matter who the other agent is that I'm working with on a transaction. But if I, as an agent, can make a transaction as delightful as possible, I know that those other agents are saying, if my buyer's offer is equal to somebody else's, and my track record is I get my clients to the closing table, that other agent who I have a relationship with is going to know that, and hopefully has that in their back of their mind and is sharing that with their client. Hey, I know this person. Chris is going to make this a great transaction, or to the best of her ability, she's going to make this a great transaction. She's a good communicator. A
good partner.
Yeah.
Dena's
going to work well with me. And Dena's track record is, if she writes this offer and we come together, her client's going to close.
Thanks, Chris.
Yeah.
That's exactly right. So relationships are important. Your realtor's relationship with other agents is important. Partnering with other agents is important. So, collaborating on the sell side with the buy side is critical to getting the deal done. Yeah, absolutely.
And finally, as a buyer, be patient. I right now cannot stress the fact that we have to be patient. We've seen the lack of inventory, and so if the inventory is not there and there are 20 to 40 people for every home coming on the market, it really may just take some patience. You may have to write 10 offers. I hate to say that,
time, right?
But and I wouldn't have said that in the past, but that may need to happen, and just know that.
Right, understanding those expectations, understanding that when a house goes on the market, your job is to get there as quickly as possible, working with that agent to get you into that house as quickly as possible, being ready to pull that trigger and write that contract really kind of on site almost.
Right.
You're not going to get the chance in this market to go back through that house twice.
Right.
Or 3 times to make that decision. So really understanding those expectations. I think that's where it's really important to have that buyer consultation with our clients, set those expectations up, and like you said, be patient, because it'll come, and you'll readjust your strategy as you go along, maybe. It's just a partnership between your agents and yourself in getting you into the right home. And we'd be happy to help with that, right?
We'd love to. Hey, thanks for joining us. Next week, we will chat with Nancy Groh. Nancy is an interior decorator, and she is going to help guide us with what are some things you should be doing right now to decorate your home, whether you plan to stay, and what are some things you should be doing if you are thinking about moving in the near future. So
exactly.
As always, like us and subscribe.
Like and subscribe. You can find us on YouTube. You can find us on Apple Podcasts, on Spotify, and anywhere else that you are listening to your podcast. We thank you for joining us all today. This has been House and Home Chat, Real Estate Real Talk with Dena and Chris.
Bye.
See you next time.